When you look at the stock market right now, it feels like it's just roaring ahead. But what if I told you that beneath the surface, something massive is shifting? While most people are watching the waves, there's a giant whale on the move, and its migration could change absolutely everything. Today, we're going to follow that money trail.
Okay, so let's get right into it. The story everyone knows, the one you hear every single day on TV, is that technology and this AI revolution are just pushing the market to insane new heights. And, on the surface, that story seems totally true.
I mean, just take a look at this chart of the NASDAQ. It's beautiful, isn't it? A really powerful uptrend hitting all-time highs. It's so easy to look at this and just think the party is never going to end. The momentum feels, well, it feels unbreakable. But as we're about to see, that's only half the story. So if everything looks so perfect on top, where's the problem? Well, it all starts with the very first crack that appears in that facade, a moment that reveals a huge divergence happening just below the surface. This right here, this is the moment the entire script flipped. For 3 whole weeks, tech, that's the gray line, it just went nowhere, chopping sideways. But then, in that 4th week, look at the blue line. That's the energy sector, a massive, almost vertical move straight up. Come on, that isn't retail traders clicking buy. That's the unmistakable footprint of big institutional capital making a very deliberate, very defensive move. So that divergence, that's our first big clue. Now, let's put on our detective hats. We're going to follow the evidence trail and see exactly what clues this smart money is looking at that's telling them a major market shift is coming. First up, we've got to zoom out and look at the big picture, the macro environment. And honestly, it all kind of boils down to this one single number, 4.35%. That's the yield on the 10-year Treasury. The source calls this the quiet killer, and for a very good reason. For Wall Street, this isn't just a number, it's a line in the sand. Every little tick above it puts enormous pressure on those high-flying, super expensive tech stocks. And this chart shows us exactly why that is. As this yield breaks out and starts pushing higher, it's a giant flashing sign that the whole era of easy money is coming to an end. Why? Well, because higher yields mean a company's future profits are worth less today. The market just stops rewarding promises of growth way off in the future and starts demanding real, hard cash flow, right here, right now. Now, let's move to our second clue, which connects directly to that whole show me the money idea. We're talking about fundamentals and a massive gap that has opened up in the market. This is wow. It's just so clear you can't ignore it. On one side, you have the tech sector trading at a forward price to earnings ratio of about 28. That's pricey. Then, on the other side, you have the energy sector sitting at just 11. The big institutions, they look at this gap, this chasm, and they see a historic opportunity. It's simple, really. They're just selling what's expensive and buying what's cheap. The market has totally shifted its personality. It's gotten impatient. All that massive spending on AI is one thing, but the big money is now punishing any company that can't show an immediate return on that investment. Meanwhile, you've got sectors with real pricing power, like energy, that are just perfectly positioned to take the lead. Okay, this brings us to our third piece of evidence, and this might be the most dangerous one of all: sentiment. This is where we see a huge split between what the pros are doing and what everyday traders are doing. And here it is, the classic trap. You can see that retail sentiment is still incredibly bullish. They're buying every little dip in tech stocks. But the institutional flows, the whale money, are moving in the complete opposite direction. They are consistently selling into that retail-driven strength. Then you add in the fact that the VIX, the market's fear index, is starting to wake up, and pros are buying puts, which is basically insurance against a market drop. You have all the classic signs of a top. All right, so we've got our clues: rising yields, a massive valuation gap, and this really dangerous sentiment divergence. Now it's time for the big reveal, where we actually map the whale's migration in real time. So before I show you the full map, here's a super quick guide on how to read it so it all makes sense in a snap. The vertical axis, that's money flow, are institutions buying or selling. The horizontal axis is valuation, is a sector cheap or expensive. That top right corner, where cheap stuff is seeing heavy buying, that is the institutional sweet spot. And here it is, the institutional sector flow map. Just take a second to look at this. This one visual
basically confirms everything we've been talking about. You can literally see the capital draining out of that expensive, silent exit quadrant on the bottom left and migrating over to the cheap, sweet spot quadrant on the top right. It's a clear, undeniable rotation out of growth and into value.
Now let's zoom in, because this is where it gets really good. This tells the entire story in just 2 pictures. On the left, you've got technology, XLK. That vector is pointing down and to the right. A classic silent exit as the big money sells into strength. But then, on the right, look at energy, XLE. Its vector is hooking up sharply, a pattern they call a J-hook, and it's a signal of aggressive new buying. This is where the smart money is aiming now, buying the dip while everybody else is looking the other way.
So, we've uncovered the rotation, and we can see exactly where the smart money is heading. The big question now is, what happens next? Let's break down 3 potential scenarios for how this whole thing could play out. Here are the 3 key signals we need to be watching like a hawk to figure out how fast and how severe this shift is going to be. First, strong earnings from the energy sector could pour fuel on this fire. Second, we've got to watch key support levels in those big tech stocks like NVDA. And third, if the VIX closes above 15, that's a sign that a volatility spike is right around the corner. All right, so based on those signals, here are the 3 potential outcomes. The most likely one, the base case, with a 60% probability, is the rotation, where a tech just kind of bleeds out slowly while value rallies. Then you've got the bear case, 30%, which is the flush, a much sharper sell-off if those yields spike. And finally, the long-shot bull case, just 10% probability, is a reversal, where this whole thing turns out to be a head fake. This brings us to our final section, and honestly, the single most crucial insight from this entire briefing. It's a really simple idea, but it's one that most people are completely overlooking right now. You know, the most powerful, unstoppable force in markets is something called mean reversion. It's just the idea that things eventually return to average. As you can see here, technology is still priced way up in the expensive zone. In past cycles, that institutional whale doesn't just turn on a dime and start buying again. No, it waits. It waits for prices to follow this mean reversion path all the way back down toward fair value before it even thinks about getting interested again. There is still room to fall. So the evidence is pretty clear. The institutional whale has surfaced, it's taking profits in tech, and it's diving deep into value. The tide is going out on one massive trade and coming in on another. The only question left is, will you be ready for the waves it's about to create?